Have a great day and welcome to my channel. In today's episode we are going to look deeper into big investment ideas in 2021. In this context, we consider the annual report published by ARK Invest. ARK Invest shared their latest report on the biggest and best investment ideas for 2021. The report is 112 pages long and covers 15 different topics in which their funds are invested. In this video, I want to introduce you the first part of ARK's big investment ideas. Let's begin. ARK Invest seeks to gain a deeper understanding of long-term impacts of disruptive innovation. The ever-increasing acceleration of technological change and breakthroughs leads to major challenges for many industries, but also offers tremendous opportunities. Here are ARK's investment cases.
Number 1. Deep learning.
According to ARK Invest, this could be the most important software breakthrough of our time. Until recently, humans programmed all software. Deep learning is a form of artificial intelligence that uses data to write software. Deep learning will add $30 trillion to the global equity market capitalization during the next 15-20 years. The graph illustrates how drastic the difference is between codes written by humans and codes written by data. Likewise, the sharp increase in the graph from 2015 illustrates how much software 2.0 is being used. Deep learning will create the next generation of computing platforms, such as conversational computers, self-driving cars or consumer apps like TikTok, and will create a boom in AI chips. As you can see on the chart, data center spending on AI processors will quadruple over the next 5 years, from $5 billion in 2020 to $22 billion in 2025. The ongoing process of development will significantly decrease the training time for different AI systems. Roughly 10 times less compute time is required. Summed up, ARK Invest believes that deep learning could create more economic value than the internet did, since the internet added $13 trillion to equity market capitalizations globally over 2 decades. Deep learning has created $2 trillion in market capitalization as of 2020.
Number 2. The reinvention of the data center.
Cheaper, faster, and more power-efficient processors are about to be implemented. Traditional data centers will go through a revolution. The reason is that new architectures reinvent the data center every few decades. The last major migration of the data center was back in the 1990s, where Intel's low-cost, PC-derived x86 architecture disrupted the conditions at that time. In the following decades, Intel grew its market share from 23% in 2000 to 92% in 2020. Today, ARM processors using mobile ecosystems to disrupt Intel. Due to this approach, Intel's market share will rapidly decline to estimated 27% in 2030, whereas ARM's market share will skyrocket to 71%. Intel failed to bring 10 nanometers processors to market for 4 years. This allowed competitors like TSMC or AMD to take over the market domination for semiconductors. While Intel has still not been able to deliver a 10 nanometers processor, TSMC is already a generation ahead and is bringing the 5 nanometers into mass production.
Number 3. Virtual worlds.
Virtual worlds are defined as computer-simulated environments and consist of video games, augmented reality, and virtual reality. ARK's estimation is that revenues from virtual worlds will compound at 17% annually from $180 billion in 2020 to $390 billion in 2025. In this context, It is also evident that revenues in the gaming industry are changing. They are shifting towards virtual goods. In 2010, revenues from in-game purchases just counted for 20% of total gaming revenues. The share of in-game revenue increased to 50% in 2015 and peaked at 75% in 2020. Think about that for 1 second. 75% of the global gaming revenue comes from in-game purchases. Next to this trend, ARK believes that the monetization of gaming will increase. During the next 5 years, the cost per hour of playing video games will increase by 20%. In addition, the average playing time will also increase from 1.1 hours per person and day to 1.5 hours within the next 5 years. Provided the trend of monetization and game time continue unchanged, in-game purchases could grow at a rate of 21% over the next 5 years. In a bullish scenario, this would lead to in-game revenues of close to $350 billion in 2025. Beside the gaming industry, there is another huge market opportunity: augmented reality. With major investments of companies such as Facebook and Apple, augmented reality is about to be implemented for a widespread use on mobile devices. Augmented reality, consisting of smartphones and glasses, could reach a $130 billion market in 2030, according to ARK Invest. In the context of virtual worlds, enormous opportunities will arise within the next few years. ARK Invest estimates that virtual worlds will grow to a $400 billion market by 2025. The gaming industry is already a $150 billion market, which is estimated to grow to $350 billion by 2025, representing 16% annual growth. In comparison, the augmented reality market is a smaller one, which will grow to just over $25 billion by 2025. However, this represents an annual increase of 59%.
Number 4. Digital wallets.
ARK Invest believes that banking apps of the future will turn the banking industry on its head. The reason is that customers will carry a bank branch in their pockets with their smartphone. Digital wallets are currently worth between $250 and $1,900 per user today. This value could skyrocket to $20,000 per user, which would represent a $4.6 trillion opportunity in the pocket of customers by 2025. One part of digital wallets are mobile payments. While this form of payment has been largely unpopular, use cases are increasing rapidly over the past few years. This is also shown by the figures from China. The volume of mobile payments has increased 15-fold within the last 5 years, from $2 trillion in 2015 to $36 trillion in 2020. In 2020, this corresponds to approximately 2.5 times China's GDP. Here are some examples of digital wallets you might know or might have heard of: Robinhood, PayPal's Venmo, Square's Cash App, N26, WeChat Pay or Alipay, just to name a few of them. JP Morgan Chase managed to grow to a bank with approximately 60 million deposit accounts through organic growth and 5 acquisitions over the last 30 years. Square's Cash App and PayPal's Venmo managed to reach the milestone of 60 million active users within 7 and 10 years, respectively. But let's take a closer look at how this rapid growth can come about. One reason is the cost of acquiring new customers within financial products. While credit card companies need between $250 and $1,500 to acquire a new customer, it takes between $750 and $1,000 to attract a customer to a brokerage platform. In contrast, only $20 is needed for digital wallet operators to acquire a customer. The reason for that is a viral peer-to-peer payment ecosystem, which lowers cost structure dramatically. Another reason is also to be found in the cost structure. The providers of digital wallets can save themselves the costs of the expensive maintenance of the physical infrastructure. After all, the bank branch of the users of digital wallets is in their pocket. In contrast, banks record rising costs for maintaining their branch network. In 2019, these costs reached new negative records in the US at nearly $600,000 per operating branch. With an increase in users and the potential value of digital wallets per user, a $4.6 trillion market may develop by 2025. This once again underlines the importance of digital transactions and value storage and shows the potential that lies dormant in this market.
Number 5. Bitcoin's fundamentals.
Once again, Bitcoin reached a new all-time high. This time, however, it seems that this is driven less by hype and more by fundamental data. While Bitcoin is well on its way to continuously gaining more trust, the first large institutional investors and also listed companies are already investing in Bitcoin. While search volume was above the price of Bitcoin during the hype at the end of 2017, search volume dropped sharply, as did the Bitcoin price. In the coming months, however, it invariably remained below the Bitcoin price, indicating a weakening of the hype and an increasing focus on Bitcoin fundamentals. The rising confidence in Bitcoin, in addition to increased investment activities by market participants, also leads to the following. Increasingly more of the Bitcoin market participants have long-term investment horizons. The share of Bitcoin buyers who hold the cryptocurrency for only a few days is decreasing sharply over time. In contrast, more and more participants are entering the market who intend to hold Bitcoin for more than 5 years. In 2020, the share of people holding Bitcoin for more than 1 year was already about 60%. ARK Invest predicts that if all S&P 500 companies invested 1% of their cash holdings in Bitcoin, the Bitcoin price would increase by another $40,000. Here are some events related to Bitcoin in 2020 and how it has evolved in price. With Square and MicroStrategy, two companies prove how balance sheet investments in Bitcoin can look like and show the way for other companies. This approach makes it clear that Bitcoin is a legitimate alternative for cash in the near future. ARK Invest's forecasts that if all S&P 500 companies invested 0.1% of cash holdings on their balance sheets, the Bitcoin price would increase by approximately $10,000. Provided 1% of holdings were invested in Bitcoin, the price increase would be calculated at $40,000. Arguably, the scenario where 10% of the cash holdings of all S&P 500 companies are invested in Bitcoin would be much more unrealistic. Nevertheless, if this might happen in the future, ARK calculated an associated Bitcoin price increase of about $400,000.
Number 6. Bitcoin preparing for institutions.
As Bitcoin's popularity grew, the hype wore off. This fact, the strong fundamental values and an excellent outlook ensures rising confidence in the most famous cryptocurrency. This also aroused the interest of major players in the market. Institutions. ARK Invest thinks Bitcoin's rapid growth has put it in a strong position for an allocation in institutional investors' portfolios. ARK's estimate is that the market can grow from the current $500 billion to between $1 to $5 trillion in the next 5 to 10 years. Bitcoin's credibility has been greatly enhanced in recent months and years. This trend will remain intact as long as Bitcoin continues to be integrated into the financial world. This can be done by regulators, banks, institutional investors or companies. OCC, for example, allows banks to run nodes on public blockchain networks to streamline payment functions. In addition, JP Morgan added the operators of two major crypto exchanges, Coinbase and Gemini, to its banking clients. Other examples of increasing integration in the financial world are Fidelity Digital holding bitcoins as collateral for cash, or PayPal announcing cryptocurrencies selling and buying services. Further insight into why Bitcoin belongs in the portfolios of large institutional investors is provided by the correlation matrix. A well-diversified portfolio includes asset classes that correlate with each other to varying degrees. As a little side note, correlation is a two-way relationship and measures the strength of the relationship between two different variables. A positive correlation of one means that if there is a positive change in variable A, there will also be a positive change of the same magnitude in variable B. Bitcoin, unlike all other asset classes, has a low correlation between all other asset classes. This indicates that Bitcoin moves separately from other asset classes and is not or hardly influenced by them. In a bearish market with falling stock prices, Bitcoin is only influenced by this to a limited extent, as the correlation with stocks is low.
Number 7. Automation.
Another investment case for 2021 is automation. While it took nearly 25 years for the density of robots in US manufacturing to reach a level of about 200 robots per 10,000 employees, the density of automation per 10,000 employees will only take the next 5 years to do so. This means that the density of automation per 10,000 employees will grow at a 5-fold higher rate within the next 5 years. For ARK, it is clear that a decrease in labor relative to capital employed does not necessarily lead to lower wages. Increased productivity and automation can lead to many economic benefits, such as higher wages, benefiting employees, lower prices, benefiting consumers, or higher margins, benefiting companies. If increased productivity allows for higher investment, this can lead to strong economic cycles. In a historical context, companies' margins have increased when the labor share has declined. A 15% decrease in the labor share could allow companies to double their margins to 20%. ARK estimates that automation could boost the US GDP by 5%, or $1.2 trillion over the next 5 years.